Hey there, I'm the Practical CFO, and welcome back to the Profit Architecture series. We're almost there. We've architected your profit system from the ground up, understanding value-based pricing, cost optimization, and profit allocation. You've captured profit. You've protected it systematically. Now comes the critical question. How do you actually get it out of your business and into your personal wealth without giving half of it to the IRS? Today, in part 6, we're covering tax-efficient profit extraction. How to take money from your business legally, strategically, and tax-efficiently. Because here's the reality. Two business owners can make the same profit, and one pays 22% in taxes while the other pays 45%. That difference, that's millions of dollars over a business lifetime. Here's the mistake I see constantly. Business owners extract profit the simplest way possible, taking everything as ordinary income. Let's look at the tax calculation. On a $200K profit, you'll pay 40 to 50% in taxes. You're giving half of what you earn to taxes, you keep the other half. Meanwhile, sophisticated business owners with the exact same profit, they pay $12,000 less per year. Over 20 years, that's $250,000 in tax savings. Same profit, different structure, $250,000 difference. And this gap widens dramatically as profit increases. Here are the tax extraction mistakes killing your wealth. Mistake 1, whole proprietorship or single member LLC taxes sole proprietorship. You're paying self-employment tax on every dollar. That's 15.3% self-employment tax on top of income tax. Completely avoidable with proper structure. Mistake 2, no tax planning strategy. You look at your taxes once a year, in April, when it's too late to do anything about it. Tax planning isn't a once-a-year event. It's a year-round strategy. Mistake 3, not maximizing legitimate deductions. You're paying for business expenses personally, missing deductions, leaving money on the table. Home office, vehicle use, health insurance, retirement contributions, all strategic tax reduction opportunities most owners underutilize. Let's explore how the Practical CFO can help optimize these areas for your business. Let's talk entity structure. This is foundational. There are 4 primary structures for small businesses. Let's start with the simplest structure, the sole proprietorship or single member LLC. This is the default for most new businesses. It's the easiest to set up, and there's no separate tax filing for the business. Tax treatment. All profit is self-employed income. Pay both employee and employer portion of Social Security and Medicare, plus regular income tax, 24 to 30% or more. When it makes sense, first year in business, under $50K revenue, part-time side business, very low profit margins. When should you graduate beyond this structure? Once you're consistently profitable above $60K annually. Structure 2, S Corporation. This is the tax efficiency sweet spot for most profitable small businesses. How it works, you pay yourself a reasonable salary subject to employment taxes. Remaining profit is distributed as shareholder distributions with no self-employment tax. So only the salary portion pays the 15.3. Let's look at a tax calculation example for an LLC. With a $200K profit, a reasonable salary of $120K pays employment tax. Pretty tight. This saves about $12,000 versus a sole proprietor tax. When it makes sense, consistent profit of $60K, $80K or more, service businesses with healthy margins, businesses where the owner provides significant services. The IRS requires a reasonable salary. You can't pay yourself $30K on $200K profit. They will auto reclassify. Let's look at structure 3, the C Corporation or C Corp. This is a separate tax entity. The corporation pays its own taxes. Tax treatment: corporation pays 21% federal corporate tax on profit. You pay personal income tax when you take distributions, like dividends. This results in double taxation. When does a corporation make sense? When raising venture capital with significant retained earnings, high profits needing sophisticated tax planning, or planning to sell the company. Most small businesses should avoid C Corps. They're generally not tax efficient due to double taxation. S Corp is usually better. Structure 4, partnership and multi-member LLC, default structure for businesses with multiple owners. Let's look at the tax treatment for partnerships, which is passed through like a sole proprietorship. Each partner pays tax on their share of the profit, and it's subject to self-employment tax on active income. For tax efficiency, a corporation can elect S Corp treatment if profitable. When does this make sense? For multiple business owners, real estate investments, or professional partnerships. Here are 5 strategies to extract profit tax efficiently. Salary distribution port S Corp, the art of S Corp optimization, finding the right balance between salary and distributions.
Salary must be reasonable for your role in industry. General guidelines: $60 to $150K profit, 60 to 70% salary, 30 to 40% distribution.
Strategy 2, retirement contributions. Retirement contributions are tax-deductible extraction of profit. For retirement, SEP IRA lets you contribute up to $66,000 a year, where Solo 401k also offers up to $66,000 in combined employee and employer contributions.
Health insurance and medical expense optimization.
Let's examine strategy 3, health insurance and medical expense optimization. For businesses, paying for employee health coverage is tax efficient. Premiums are deductible to help the line. Here are key tax efficient strategies. Home powerful tool is the HHSA, offering a triple tax advance. Contributions are deductible, growth is tax-free, and meta-reimbursed medical withdrawals are tax-free.
Strategy 4. Maximize your business expense claims by deducting home office and vehicle costs.
Legitimate business expenses like a home office can be deducted. If you have a dedicated space, you can deduct a percentage of mortgage, utilities, and maintenance. This typically results in a $5,000 to $15,000 annual deduction. Tax-efficient extraction strategies can optimize your business finances. Let's look at vehicle deduction methods. You can use standard mileage or actual expense is critical. Track your mileage, photograph your home office, and keep all receipts.
Strategy 5. Spousal employment strategy.
If your spouse legitimately works in the business, wages become a deduction, and family health insurance can be deductible. Spouse can contribute to retirement plans, enhancing tax deferral. Income splitting can reduce overall tax bracket. This also creates a second Social Security earning record. Together, these strategies optimize your financial future.
Here's your implementation roadmap for tax-efficient profit extraction. Q1, Entity Structure Review. Review current entity structure with CPA tax attorney. Analyze prior year tax return for optimization opportunities.
Q2 strategy, maximize deductions. Follow our roadmap, assess, strategize, implement, and review. Key actions, set up retirement plans, establish home offices, and track mileage. Q3 July-September, mid-year tax planning. Project year-end taxable income with CPA, estimate Q4 estimated tax payments needed, evaluate additional retirement contributions.
Q4 year-end optimization. Maximize retirement contributions before 12/31, prepay January expenses if beneficial. Make final estimated tax payment. Document all deductions, compiling receipts and mileage logs. Make charitable contributions if applicable to your situation. Review next year's strategy with your tax advisor for ongoing optimization. Every quarter, follow this simple routine for tax optimization. Pay estimated taxes, review profit extraction, meet with your tax advisor, and adjust your strategy.
Warning 1. Get professional tax advice. I'm giving you frameworks and strategies, but every business is different. Every state is different. Tax law changes constantly. Work with a qualified CPA or tax attorney. Yes, it costs $2,000, $5,000 annually, but they'll save you $10,000, $50,000 plus in taxes. The ROI is enormous. Warning 2. Everything must be legal and debented. There's a difference between aggressive tax planning and tax evasion. Document everything. Keep receipts, track mileage, prove business purpose, maintain separate accounts. If audited, documentation is your protection. Warning 3. Don't let tax tail wag the business dog. Don't make bad business decisions just for tax savings. Don't buy things you don't need just because they're tax deductible. You still spent the money. Tax efficiency serves business success, not the reverse. Here's the bottom line. It's not what you make. It's what you keep. Tax efficient extraction is how you keep it. These are our key tax-efficient extraction strategies. Schedule a tax plan meeting with your CPA this month. Not in April, now. Review your entity structure and extraction strategy. Next week, in Part 7, the finale of this series, we're covering the profit metrics that actually matter. Which numbers to track, what they mean, how to use them to make better decisions, and the complete profit architecture dashboard that brings everything together. Subscribe and hit notifications. Part 7 completes your profit architecture system with the metrics and dashboard that keep it running optimally. Don't miss the final piece. Comment below, what's your current entity structure? Sole prop, LLC, S Corp, or C Corp? And what's your profit level? Let's see if you're optimized. This is the Practical CFO helping you build wealth the smart way.